Welcome everybody, this is George Veter Financial, giving you an update as we close out August here in the summer of 2022. The weather out there economically continues to be turbulent, but we have made progress since our last discussion. So I just want to kind of frame where we're at and where I see us going and help a little bit with maybe some mindset so that we can stay calm in the midst of this disruption that we're working our way out of. The first half of the year, we talked about our problems with inventory levels, that we just didn't have anything. Because of the pandemic, we shut down manufacturing of so many things in so many sectors that when consumer spending roared back and the world started to wake up from the pandemic lockdown, we just didn't have product, which created this perfect environment for inflation. Because when you have a spike in demand and you don't have any products, obviously the people making those products can charge more for it. And that's just cause and effect as it relates to inflation. But we have had a lot of relief. For example, the building world has changed a lot with the rise of interest rates and the change in the environment for the housing market. We've seen housing starts fall off a cliff. Just in July, they were off another 11% versus the month before. As a result, building materials have started to decline. It's just showing that on the peak was March 2nd for lumber contracts, which are 1,000 board feet. And at that time, you paid over $1,400 for 1,000 board feet of lumber. And now they're $495, telling us that economists that deal in that part of the economy see things continuing to get tougher for the building industry, which alleviates the pressure of out of control upward pricing. So there's good and bad in that. And those of us that had the opportunity to sell property at this frothy real estate market, that was probably a wonderful time to do that. Things in the future may change. History tells us that they will. Also, we have inventory levels of a lot of things. Two more examples. This morning, CNBC talked about inventory levels of microprocessing chips. If you remember early in the year, all the news was about how we didn't have enough chips, and now we have an oversupply. So the concern now with the chip index is that we have too many chips and user end is going down or demand is waning. So they believe that prices will have to go down, which is not good news for the semiconductor and microprocessing chip makers, but it's good news for the consumer that's going to get a break on their end of consumption. So we have a lot of those type of trends. We had Target that came out with bad news on their earnings a couple of weeks ago. What was interesting is that Target remains just a great retailer, but they had too much supply, and so they're having to slash prices in different areas where they're over inventoried in order to make room for what they now see they need for Christmas. And if you remember a couple of quarters ago, you'd go to a Target or a retailer like that and there was just essentially nothing on the shelves. So we are getting the things that we need in order to turn around this high, intense pressured inflation economy, moderating, peaking, and starting to decline. Now, the market's been a little grumpy the last few days, primarily because the Fed released their notes from Jackson Hole, or at least some of their information, and they didn't give any relief on their stance that they want to stay tough on inflation. And now the odds makers are giving a higher percentage chance of a 75 basis point move in September. I mean, I don't know if it's going to be 50 or 75 basis points in the big long picture. I'm not sure how much that matters. I just know the Fed is staying vigilant. Between now and the time where the Fed has enough information, such as what I've mentioned to you, that inflation is peaking and moderating, and he can back off the pace of interest rates whenever that is, next year or fourth quarter or whatever it is, the market will take a big sigh of relief, and then that will help us get into the next bull market. Between now and then, we'll have moments that are scary, like Friday was, where people panic. I just want to make sure that we're not panicking. If we're over emotional, we automatically do the wrong thing as investors. History tells us. When we have those days, I always remind myself that nothing changed, right, for U.S. companies. If you like Google, for example, or Alphabet is its trading name. If you like Google, well, they were down 5% on Friday, but nothing changed with the company. fact, they've made 27% in net profit over the last 12 months. So yet they were down 5% in one day. It was an emotional reaction to how they interpreted the Fed's speech. So we can't get sucked into that. I have a really good friend of mine that's a financial advisor in St. Petersburg, Florida, Glenn Ullman. Very successful in this business, but before he was in this business, he was a pilot. And he used to always use the analogy that I borrowed from him, that when you're in a plane and you hit turbulence, you need to stay in your seat and buckle up, not look to jump out the window. And it's funny, as investors, we're going to hit turbulence from time to time. We're going to have dislocation and disruptions in the free market world. That's something that we expect, we know is a part of cycle, but the media as well as marketers of different things understand that people buy on emotion, so they're going to try to bat us in the way of making emotional decisions which are rarely in our best interest. The last thing I want to mention, one of my heroes in this business, Jack Bogle, he was the founder and former president CEO of Vanguard Funds, and he's now deceased. But he, one of his things that he liked to say when he would publicly speak is that the act of investing is always an act of faith. We give our capital to corporate stewards of our capital, and they innovate and they build wealth for us through the use of our capital. And we have to have faith that always has happened economically. That incentive system of building things and making things better and profits coming in relationship to those factors will continue to happen in the free world, and that the U.S. economy will continue to thrive and grow as it has throughout history, and that free markets around the world will do the same thing. And if we do it the right way, it's the best way that we can beat inflation, pay distributions, and keep hold of our wealth and pass it to the next generation safely. So I just want you to know that I know this is a time when the news can be positive one day, negative the other day. I just want us to stay steady. I want to do a great job in communicating, so through perspective and through data, I can give you the big picture so you don't get sucked into a negative bite that takes up too much room in your life. Okay. Again, I'm grateful for the opportunity I have to manage your money, and all of us here at Viter Financial, all my wonderful staff and other advisors. Every day we go to work and we fight for our clients, and we love them, and we want everybody to have great experiences long term, and we want to nurse us through those moments where it's painful to get to the reward. And anyway, that's my update. So grateful for all of you, and I look forward to our next message.